When it comes to investing, the idea of growing your wealth can be exciting, but it can also be overwhelming. There are so many options, terms, and strategies to consider, and it's easy to make costly mistakes if you're not careful. Whether you're just starting out or have been dabbling in the markets for a while, avoiding common pitfalls can set you on the path to financial success. Today, I want to talk about 5 costly mistakes that beginners often make in investing and how you can avoid them. The first mistake is trying to time the market. If you've heard the phrase buy low, sell high, you might think it's as simple as waiting for the right moment to make your move. But the truth is, trying to time the market is incredibly difficult. Even professional investors, with their deep knowledge and experience, struggle to predict the exact highs and lows of the market. Beginners often think they can get in at the perfect moment, but this can lead to buying at the wrong time and selling in panic when the market dips. Market timing also causes many investors to miss out on long-term gains. Instead of trying to guess when the market will peak, a more effective strategy is to stay invested for the long haul. Historically, the stock market has trended upwards over time despite short-term volatility. So rather than obsessing over short-term price fluctuations, focus on your long-term goals and let your investments grow steadily. The second mistake is failing to diversify your portfolio. This one is crucial, but often overlooked by beginners. Diversification means spreading your investments across different asset classes like stocks, bonds, real estate, and commodities. By doing this, you reduce the risk of losing everything if one particular asset class underperforms. Think of it like putting all your eggs in one basket. If that basket falls, you risk losing it all. But if you have multiple baskets, the chance of all of them failing at once is much smaller. Many beginners, eager to make quick gains, often put too much of their money into one stock or sector. While the potential for big returns may be tempting, this strategy can lead to massive losses if that stock or sector takes a hit. Instead, try to build a well-rounded portfolio that includes different types of investments, even ones that may seem less exciting. Over time, the balance of these assets will help minimize risk and maximize growth potential. The third mistake is ignoring fees and expenses. Investing might seem like a way to make money, but it's important to remember that every investment comes with costs. Whether it's the expense ratio of a mutual fund, trading fees, or commissions charged by brokers, these costs can eat into your returns over time. A seemingly small fee might not feel like a big deal in the short term, but over years or decades, it can significantly affect your wealth. This is why it's crucial to pay attention to fees, especially when it comes to passive investment strategies like index funds or exchange-traded funds, ETFs. These funds often have lower fees compared to actively managed funds, which means more of your money stays invested and grows. If you're not sure what fees you're paying, take the time to review your investment statements and compare different options. Reducing fees is one of the easiest ways to increase your returns in the long run. The fourth mistake is investing without a clear plan. One of the biggest reasons beginners lose money is that they dive into investing without setting clear financial goals or understanding their risk tolerance. When you don't have a plan, you're essentially flying blind. You might make impulsive decisions based on emotion, like selling off investments when the market drops or chasing after the next hot stock, and this can lead to poor outcomes. Before you start investing, take the time to understand why you're investing. Are you saving for retirement? Do you want to fund your children's education? Or are you looking for a short-term investment to build wealth quickly? Your goals will influence your strategy, and your risk tolerance will help determine the types of investments that are right for you. For example, if you're young and investing for retirement, you might be willing to take on more risk with stocks, whereas someone close to retirement might prioritize safer investments like bonds. Finally, the fifth mistake is letting emotions drive your decisions. The world of investing can stir up a lot of emotions, especially when the market is volatile. Fear and greed are powerful emotions, and they can cloud your judgment. When the market is in a downturn, it's easy to panic and sell off your investments at the worst possible time. Conversely, when the market is soaring, you might be tempted to chase after the next big thing, fearing that you'll miss out on potential gains. To avoid these emotional pitfalls, it's essential to have a long-term perspective and a strategy that aligns with your goals. When you stick to your plan, you'll be less likely to react impulsively. If the market drops, remind yourself that these fluctuations are normal and that long-term investors usually see their investments recover. And when the market is up, resist the temptation to chase after quick gains. Stick to your strategy and let your investments work for you over time. These five mistakes, trying to time the market, failing to diversify, ignoring fees, not having a clear plan, and letting emotions drive your decisions, are all avoidable. By understanding these pitfalls and being mindful of them, you can avoid costly mistakes and set yourself up for financial success. The key to successful investing is patience, discipline, and knowledge. Stay focused on your long-term goals, continue learning about the markets, and remember that investing is a journey, not a sprint. Lastly, don't be afraid to ask for help. If you're unsure about where to start or what investment options are best for you, consider working with a financial advisor. A professional can help you build a personalized investment strategy and guide you through the complexities of the market. And remember, investing is a skill that improves with time and experience. The more you learn and practice, the more confident you'll become in making smart investment choices. One of the most common mistakes that beginner investors make is trying to time the market, trying to buy stocks when they believe the price is low and selling when they think it's high. This might seem like a smart strategy, but the reality is that market movements are incredibly difficult, if not impossible, to predict with any degree of accuracy. Even the most seasoned investors and financial experts struggle to consistently forecast market trends. They may successfully time some trades, but no one can predict every upturn or downturn with certainty. The main problem with market timing is that it's based on the belief that you can correctly identify when a stock is at its peak or its lowest point. The truth is, markets can be unpredictable and influenced by countless factors, some of which are outside of any investor's control, such as global economic events, political changes, or even unexpected news. This makes timing the market a game of chance more than a strategy based on research or data. Instead of focusing on short-term price fluctuations, a much more reliable approach is to invest for the long term. Historically, the stock market has trended upward over time, despite periodic dips and crashes. By staying invested over a long period, you can take advantage of the market's overall growth, even if there are short-term downturns. This strategy removes the emotional roller coaster of trying to predict the perfect time to enter or exit the market, and it allows you to ride out the inevitable volatility. Long-term investing also allows you to benefit from compound growth, the process where your earnings generate more earnings. Over time, this can significantly increase your wealth much more effectively than trying to time market peaks and valleys. By focusing on your long-term goals and staying invested, you're more likely to achieve solid returns. Another mistake that many beginners make when they start investing is putting too much of their money into a single stock or sector. This might seem tempting, especially when a particular stock or industry is performing well, but it's a risky move. If that stock or sector faces a downturn, your entire investment can take a major hit. Imagine investing all your savings into a company that seems to be growing fast, only for it to experience a sudden decline due to an unexpected event, like poor earnings, regulatory changes, or a shift in consumer preferences. Without diversification, you could find yourself facing significant losses. Diversification is one of the most effective strategies to reduce risk in your investment portfolio. By spreading your investments across a variety of asset classes, such as stocks, bonds, real estate, and even commodities, you can protect yourself from major losses if one particular asset or sector underperforms. When one part of your portfolio experiences a loss, other areas might be performing well, helping to offset those losses and stabilizing your overall returns. A diversified portfolio doesn't just mean owning a mix of stocks. It's about investing in different sectors, industries, and even geographical regions. For example, rather than investing all your money in technology stocks, you could balance your portfolio by also adding some bonds, healthcare stocks, or real estate investments. This way, if one sector faces a downturn, your other investments may still do well, helping to smooth out the performance of your overall portfolio. Over time, diversification can lead to more stable and consistent returns, helping you navigate market volatility with more confidence. The goal is to minimize risk while still participating in the potential growth of various markets, giving you a better chance of success in the long run. Investing isn't free, and one of the most important aspects beginners often overlook are the fees and expenses associated with their investments. While it may seem like a small issue at first, fees can significantly erode your returns over time. These costs can come in many forms: fund management fees, brokerage commissions, trading costs, or even advisory fees if you're working with a financial professional. While individual fees might appear minor on the surface, they can accumulate quickly, especially when you're holding investments for a long period. For example, if you invest in mutual funds, many actively managed funds charge high management fees in exchange for professional portfolio management. These fees might be justified in some cases, but for most investors, they can add up to a significant portion of their returns, often without significantly outperforming lower cost alternatives. Similarly, frequent trading or paying high brokerage commissions for buying and selling stocks can quickly cut into your profits. Over the long term, these fees can compound and reduce the total gross of your investments. To avoid this, it's crucial to choose low-cost investment options whenever possible. Index funds and exchange-traded funds, ETFs, are great examples. They usually have much lower fees than actively managed funds, and their performance often matches or exceeds that of higher-cost alternatives. Since index funds and ETFs typically track the performance of a broad market index, such as the S&P 500, they offer broad market exposure at a fraction of the cost of actively managed funds. Being mindful of the fees you're paying can have a huge impact on your overall investment strategy. It's essential to consider how these costs fit into your long-term goals and to make sure you're not paying more than necessary. Over time, the less you pay in fees, the more of your returns you get to keep and reinvest, ultimately growing your wealth. Always review your investments to ensure you're minimizing costs and maximizing your gains.